Yeah, it really did, Dave. It's one of those things where we were hoping yesterday maybe we'd get that same kind of bounce we got the day before, but we went back the other direction. So it was kind of the opposite of Monday.
Boy, it really and truly did. It was downright ugly. It was like nothing sounded like it was going to work out properly on the trade talks. There was no really good news to be had there. The Chinese delegation did say they're coming to Washington. They're sitting down with the Trump trade people, but no news yesterday turned into bad news when it came to investments, didn't it?
Yep, it really did. So um, it was not a pretty day at all on Wall Street. So
Not by any
yeah,
measure.
not pretty at
Kind
all.
of lead, kind of leads us into what the analysts are saying down the line, and it's interesting. And this kind of gets the point as to why it's more art than science. And your advice of hedging one's bets as far as market volatility makes sense. One thing caught my eye this morning. Jamie Dimon, the big banker, was saying, "Yeah, there's an 80% chance trade deal's going to happen. Everything's going to be right with the world. So invest accordingly." Jamie's obviously saying, don't worry about this dip. This is an opportunity to buy some stocks at bargain prices. And boy, a few of them got to be bargain prices yesterday with the kind of dip we had on the Dow and the S&P. You found another analyst that was saying, boy, the out years really don't look all that pretty, do they?
Well, this guy's not an analyst. He's just an academic research guy that does a lot of research when it comes to the stock market performance. And
Mm-hmm.
his take as he looks at the next 5 to 10 years, and he broke it down to 5 years because that's a much less time frame, and he could get his hands around it a little bit better. But he said total return. He's looking at a total return on the S&P 500 of zero over the next 5 years. 5 years from now, zero return, and that includes dividends. So what that means is that if you take the dividend, you're basically, if you look at your portfolio and don't reinvest the dividends, then you're going to be negative at the end of that 5 year period of time.
I'm kind of doing the math in my head here as I go, and it's not going to be anywhere close. But the S&P starts out the morning at 2884, according to that guy. 5 years from now, the S&P going to be down around 2,000. Would I
But
be guessing? You assume a
I'm
three or
not
four.
sure what the actual. I mean, if you figure that the S&P probably the dividend rate's probably what 3% maybe 2.5.
I was kind of compounding 5 years worth of it going down to about 15% or so,
Yep.
and I was looking at down around down around 20 to 2200, and that kind of smarts, don't it?
Yeah, it really does. And so you think in terms of, hey, when you initially read that, it doesn't sound bad, right? We're just going to be even. We'll be at zero. But that's not the case because most people aren't reinvesting those dividends. They're taking them out. And so if you're spending the dividend, then your actual portfolio on paper is going to be negative.
Now, for the sake of full disclosure, we got to say that's one researcher and one opinion. And like I said, Jamie Dimon is saying, hey, everything's coming up roses, but it does kind of emphasize the notion that nobody knows for sure what the Sam Heck is going to go on. And hedging one's bets with some stability in one's portfolio really makes good sense, doesn't it?
Well, it does, Dave. And it goes back to even, Jack Bogle, his last interview, the last part of last year before he passed away. He said basically that he expects very little return in the S&P 500 over the next 10 years. He said it's not going to be anywhere close to what we've seen in the past history. He expects 4 to 5% was what his expectation was, including dividends. So that means there wasn't going to be much capital gains even in his predictions.
So we've got a few big black clouds floating out on the horizon called analysts and researchers, right?
Yep, that's true. That's so true.
That'd be fair. Speaking of black clouds on an anecdotal basis, I have to get a kick out of it, but I'm sympathetic to it. Uber due to be doing their IPO this week, their public offering for the first time. Tomorrow is the date in which customarily they would set the price for the initial offering of that stock. So what happens this morning? Bunch of Uber drivers say, "Hey boys, we're on strike. Hey, let's take the people that are feeding you and feed them a sandwich full of excrement all on the day before the price comes up," right?
Yeah, I mean, they're going to walk out. They're not going to log into their apps. They won't be available to drive. So maybe that's an opportunity for some of them Uber drivers to make some really good money. But Uber's not the only game in the player field. So maybe that benefits Lyft.
I was
Um,
just saying, be happening a lift stock this morning off of that information, right?
and then on top of that, you've got regional car services too. So you know what? If we survived without Uber before Uber got here, and so yeah, is it going to hurt the company? It probably will, but ultimately, it's going to hurt those drivers down the road.
Yeah, and the best case scenario from their standpoint is they cost the initial public offering for Uber a few $1 million worth of value, and that means Uber is going to have less resources available to be able to market their services so that down the line the drivers can make more money. I mean, they're an independent contractor, which means by automatic definition they can be replaced in a heartbeat. I'm not sure this is the smartest thing to do or the timing, right?
Exactly, I agree 100%. It's just I don't think it's a smart move on their part. Especially when we talk about Lyft a little bit as far as what their earnings were for the first quarter this year.
Speaking of which, let's get into it down the line because it is still earnings season. You found some household names. Did Lyft report? I didn't realize that.
Yes, they did. Lyft reported after the market yesterday, after the market closed yesterday, and so their first quarterly report since going public, they lost $1.14 billion in their first quarter. That seems like an awful lot of money to me. But they think that this year will be the peak year for losses and that it sees some clear path to profitability. And I would think I sure as heck hope so, given people pay for their stock, and they're trading down right now. Lyft's trading down right now, 3.5% after closing down yesterday, 2%.
Good heavens. I was kind of wondering whether that 1 billion plus loss actually beat the street. That would be the cynical reaction, wouldn't it?
Yeah, I don't think you have any analysts really following it yet. There's no, usually the first couple quarters, nobody comes out with any kind of recommendations or any idea of what's going to happen.
And losing $1 billion a quarter, generally that doesn't attract a lot of analyst attention either, does it?
No, it really doesn't. That's the truth.
Understood. Some other household names that reported this morning, sir.
So we got some local guys around here. We got Office Depot. They reported they came in basically even in earnings. The revenue was a little bit above forecast. Now they came out in their their phone call thing saying that they were disappointed with the quarter. They had poor performance from their CompuCom division, and said they're going to start implementing some company-wide cost reduction programs. Now, they're an inexpensive stock, to say the least. I mean, they trade in the $2 to $4 range in the last year. They're up 5.3% right now, but they lost 5% yesterday. So basically, they were down 12 cents yesterday. They're up 12 cents this morning before the market opens.
So they're basically holding steady off of a report that might have been a bit of a disappointment.
Yeah, exactly.
All righty.
So we've got Wendy's. Everybody likes to go get those hamburgers. They came in 3 cents above estimates. Revenue also was beat the forecast. Same restaurant sales matched estimates at 1.3%. And so they're trading up almost 2.5% this morning. They're getting really close. Their 52-week high is 19. And they're right now, that if they opened right now, they'd open at $18.91. So they're really close to their 52-week high.
Cool. Glad to hear good news in disposable income-based stocks like Wendy's.
Yeah, but now here's some disposable income stocks. It's not quite so good. TripAdvisor. TripAdvisor, they beat estimates by 5 cents a share. And revenue, though, was a little short. And then they came out, looking at projecting ahead. They basically come out and said they see a slowdown in their non-hotel revenue growth. And so they're down a little over 6% this morning. And they were down about 2.25% yesterday.
I wonder whether some of the airlines pushing the notion of go to our airline site individually instead of through these clearinghouses is starting to mess with the future growth for these online travel agencies. We've heard that a little bit from a couple of others as well. They just haven't been making the revenue they expected, and a lot of it is I kind of get pushed by my pet airline to reserve through their website instead of through the travel agencies, and that's got to be taking a bite out of their revenue.
Well, I think it probably is, but I don't know how much revenue they really get on the airline side, because I know travel agents as a whole, they don't get anything anymore. They have to add to the ticket usually if they book your airline ticket. Now cruises, I think are different cruises. They still get commissions back on cruises. So, it could be that rental cars, and those type of things, and then vacation packages. A lot of times they'll wrap a whole vacation package together, and they make more money that way.
Yeah, and the ads they put on the cable TV and whatnot are always pushing the hotel reservations in contrast to the travel businesses themselves. So they see the writing on the wall that the destination is where the money's made, not the transit.
Exactly. Then we have Match.com or Match Group, which is Match.com, Tinder, those kind of dating services. They came in 10 cents ahead of the estimates. They gained more subscribers, beat forecast on revenue, so they really had a good quarter. They're up a little over 5.5% this morning. Actually, at open right now, they would set a new 52-week high.
Cool. I didn't have the actual number, but I noticed the old gray lady actually beat the street too, the New York Times. What a concept. We thought newspaper was dying.
Well, yeah, but they beat analyst expectations, right? So we talked about this before. Expectations are getting a lot lower.
Yeah, I got you there. Setting the table for this morning. Like we mentioned, it was a bloodbath yesterday on Wall Street. Dow was down 473. NASDAQ was down the better part of 160. They were our biggest loser of the three indexes, down almost 2%. And the Standard & Poor's dropped 48.5 points on a lower number like a 2,800 range index. That's also 1 2/3%. It was a crummy day. 45 minutes before we open, Phillip, are we going to do any recovery today?
Well, Dave, it looks to me like right now we are not going to be recovering. A matter of fact, the indexes have oscillated. The futures have oscillated from the time I got up this morning, got to the office. They're a little better. Now they're back down again further. So the Dow right now would be down 137 points, about 0.5%. S&P 500 down 17, which is about 0.6%, and then NASDAQ coming at the highest of all, down $60 or about 0.75%. We do have gold and silver ticking up just a little bit. Gold is at $1,292 an ounce, and silver is at $14.95 an ounce, getting back up close to their numbers. And crude oil is bouncing back up a little bit to $61.55 a barrel, and today is crude oil inventory day. So we'll get that number later this morning.
And it could make an interesting change before you and I talk tomorrow morning. Overseas stocks, Asia generally is in a sell-off as well. Japan and China both well over 1% at the close this morning. Europe is mixed this early in their trading session. Phillip, somebody needs some stability in their retirement, and based upon what we're seeing number-wise today, that would be a good idea. How do I find you on the phone?
Well, everybody out there is telling people to get in the stock market. That's where you're going to make your returns. Hey, we're different. We're telling people they need to allocate based on their risk, and they need some safety in that portfolio. And if you'd like to get a risk analysis of your portfolio, call us at 382-0037 to schedule that time. Follow us on our Facebook page at Statler Financial Services, and then join us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 730. And guys, you can stream it from wherever you are on their website.
All righty. Yeah, we do. NewsTalk730am.com. Phillip, thank you so much. We'll catch you in the morning, all right?
All right. Thanks, buddy. Talk to you later.
Be well, my friend.